Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins. And joining us again this week is Coutts CIO Fahad Kamal. Welcome, Fahad.
Thank you very much, Sarah. Pleasure.
Lovely to have you back on. And as always, we're going to be looking ahead to the three things investors need to know, not just for the week ahead, but sort of longer term, sort of thematic trends. And, you know, sometimes we get Alan to do the research so that you don't have to, or sometimes he has a bit of homework to do, but we'll be picking up on that in a moment. But before we get to that, there's just one thing we need to talk about in the chit chat, and it is coming back to one of our favourite themes, passive versus active. And we had a really interesting email, a question in from one of our listeners, Francesca, and she raised a very interesting point, didn't she, about the sort of the impact of sort of algorithms on sort of passive versus active investing.
She did. Hi, Sarah. Hi, Fahad. Great to have you back. Because I know from experience it can be lonely being CIO of Coutts. You're never going to be lonely here on the podcast. So look, Francesca raised a great point, and she's partly right. And I thought, look, we'll come back to it in more detail. You can give me some homework, but I will cover it briefly here. And the way I'll do it is, imagine Coutts or anyone is putting 100 million into a passive equity fund, an index equity fund, and an active fund, and to see where she's coming from. In terms of algorithms, there's also the classic CTA macro players, but again, that's a different topic. So imagine Coutts or anyone puts 100 million into global equity index fund. Yeah. And there she's quite right. Basically, let's say there's 1,000 stocks, all 1,000 stocks need to be bought. And where she's onto something on an algorithmic basis, if it's an ETF, for example, you have specialists like Jane Street, specialist ETF market makers. They will straight away hedge out the US equity exposure with the S&P 500, effectively buying all 500 stocks. Now, that's quite important because there's a misconception, kind of a separate point that, index buying is favoring the Magnificent Seven. The Apples and the Amazons. No, it's buying just as much General Motors and Citibank as it is Apple. But nevertheless, what it is absolutely immediate. And then for the harder to so-called hedge markets, some in Europe, they'll buy a basket of stocks like an algorithm. Because if you're Jane Street or anyone, you want to make a little bit of money out of this. What you don't want to do is just say, hey, okay, Coutts or whoever's just bought 100 million. Well, we'll just go with that. And, markets go up 2 or 3%. They hate those kind of losses. So there will be an algorithm there, basically the intuition, buying nearly all 1,000 stocks. And the impact is immediate, 100 million in the market. Yeah. But the secondary point I'll reiterate, there is no bias. Just as much Lloyds Bank here in the UK, because we're talking global equity, is bought as Apple stock in the correct proportion. So that's the index part. Yeah. On the active side, I thought let's have a look at Fundsmith. And this is not necessarily about a particular mandate that inside Coutts funds, but Fundsmith is probably the most well-known global equity fund there is, active fund. Terry Smith, he's done a great job in the long run, focused on quality equities. It's a 24 billion fund. Yeah. So let's think about the impact. Coutts puts 100 million into this. They already have 800 million in cash. They may actually do nothing. Or they may, and this is the counterintuitive, one of their most successful investments, which they overweight, is Microsoft. So they may put some more money into Microsoft. They're definitely not buying Citibank. I think Terry would rather shoot himself than buy Citibank. And they're definitely not buying General Motors. So perversely, because the only successful active funds out there in the equity space are growth or quality, it's active investing that boosts the Magnificent Seven. Okay. But there's less of an immediate impact on the market. Terry and team may take their time, invest that 100 million slowly, may just buy some Microsoft because the results are going to be out. Maybe they're going to be good, even though they're not short term, maybe top up one or two other stocks. So you can see, Sarah, it's a big topic, but Francesca's definitely onto something. The index buying is very algorithmic, bang, straight into the market.
Yeah. Is it very momentum orientated then? In that case, it sees a stock going up, so it automatically goes into that stock.
No, but it's momentum for the overall market.
Right.
But see, this is where I think, Sarah, dare I say, I know it pains me to say you're slightly wrong, but I'm going to have to say you're slightly wrong.
What?
Again, I reiterate,
No, it's not possible.
When you buy an index, you own Microsoft in the right size of the market cap, just like you own General Motors in the right size of the market cap. So you're not momentum buying Microsoft. Arguably, it's the active global equity fund that says, you know what? I'm sticking with my growth quality. I'm going to top up my Microsoft. So it's the other way around. But as we can see from this just little discussion, this is a deep subject.
Yeah.
And hey, Sarah, we're always fans of having new topics, right? So let's save this for another week to go into more depth.
We're definitely going to come back to this one. You thought we'd done with active versus passive, but no, it's back, and it will be back again. Because I think, as you say, it's an endless topic, and there's lots of sort of bits and bobs to be looking at in this. Okay, so thank you very much, Francesca. That was a really good sort of talking point to get us thinking. Okay, so the rules are, when we've got a guest on, we've got Fahad joining us. Fahad, you get 2 things. Alan, you get 1. So Fahad, what are the 2 things that you think investors need to know about this week?
Fahad, you can tell this is live and unscripted because you were on mute. It's
Indeed,
okay. It's a safe space. It's a safe space.
But we so today the 2 topics that I will be covering is gold. For one, obviously we are in a world of heightened geopolitical stress, etc., and it's always a timely conversation at times like that. And China, the other sort of big question that comes up often with clients is, what do we think about China? So we'll cover a bit about that.
Excellent. Yeah. And then Alan, what's yours? I know what yours is, but
well, because we've had more feedback, haven't we? We've had feedback.
This has been one of the hot topics. Was your very mathematical, very sort of rational approach to property investing, and you had some people that agreed with you, and there are 1 or 2 people that disagreed with you. So we're going to revisit that, aren't we?
We are. We're gonna come back to that. Yeah, and don't worry. Yeah, those of you who've been in touch, we'll get your name out. But I'm also going to have a look at the commercial property market as well, because we haven't covered that for a while. Okay. Yeah. Well, let's come back to you then, Fahad. I think let's start with gold, which is it's probably the oldest store of value, isn't it? And it is it's a classic sort of element of a sort of a multi-asset portfolio. Why is it you think we need to be talking about gold this week? I mean, I've kind of guessed what the answer is, but your thoughts on the importance of gold at the moment?
Yeah, Sarah, look, I've alluded to it. Obviously, we are in a world of some stresses that we can see, and many that we probably can't see, and we'll have no idea about until they hit us, right? But even just the ones that we can see, particularly on the geopolitical front, we've got tension. Tension is a very understatement regarding the Middle East, but we've got obviously a war still raging in Russia and Ukraine, and we've got this perennial tension in the South China Sea as well. So lots of things that are worrying, and this geopolitical question has come up. Now, usually, the right thing to do in investing is to generally consider geopolitics a red herring and look through it, but not all the time, right? And the one time in history that it paid very handsomely to pay attention to geopolitics and to protect portfolios was during the 70s and the aftermath of the Yom Kippur War. Lots and lots of parallels to that for today as well. So it's not as easy or lazy to be just dismissive of geopolitics. I think that this year in particular, we should pay attention to it with the additional complications that may arise from various elections that we've got around the world, particularly a big one in November in the US.
Yeah.
So that is why we are discussing gold. This is why it's coming up more and more now. So what does gold have to do with any of these geopolitics or anything like that?
Yeah.
As you've mentioned, for thousands and thousands of years, right, which is an important factor, right? The network effect, as it were, for gold is huge. People, whether you are in a souk in Cairo, whether you are on a waterboat sort of market in Thailand, or whether you are in high finance in New York, everybody will take it. There is a clear and demonstrated value of it in the market everywhere, and people are generally happy to accept it. Those are, in a way, that's sort of the thing that Bitcoin doesn't have right now. While it,
Yeah.
brands itself as digital gold, it just doesn't have that level of thousands of years of history and network effect that gold does. Now, that's one point. I see Alan wants to jump in.
Well, you mentioned Bitcoin. I had to come in. I wish I'd thought of this, Fahad, because it's actually Merrin Somerset Webb, who you may know from Bloomberg. She calls gold physical Bitcoin. The other way around. She's a real gold bug. She has pretty good podcasts, not as good as ours, but I think you're right. Gold is a belief system, but absolutely right. Proven over thousands of years, whereas Bitcoin is a very, very speculative recent belief system. It may be around, but gold is absolutely a proven store of value. But I do think we need to step back and agree it is a belief system, but a proven belief system.
And it does have an intrinsic value in other uses, doesn't it? In industry, in the making of jewelry, as a beautiful object. I think that's the other argument, isn't it?
Yes,
I guess my
sorry,
Fahad. No, I was going to say my challenge, though, is, and I think this is the challenge that a lot of people have about gold, is that there's no yield with gold, is there? You don't earn any income from gold. It sits in your portfolio. It hopefully increases in value. You sell it, and then you take the profit. But you're not earning any yield from that gold whilst it's sitting in the portfolio, are you?
No, you're not at all earning, and that's sort of one of the negatives for gold in an environment where you're clearly getting a yield on cash of 4.5%. But the point that Alan made about it being a belief system is really critical, because at the end of the day, everything is a belief system, right? I mean, the US dollar is what it is because everybody believes that these bits of paper with presidents on it has convertibility and transferability and store value. Otherwise, it's just a piece of paper, right? Why is a Zimbabwean dollar not as valuable as an American dollar? It's because people believe in one and not the other. Simple as that. Fiat currencies are ultimately effectively large belief systems, and network effects matter, right? So by network effect, just for those who don't know, is the sheer number of people that are willing to be part of that network and accept it as a means of exchange. Now, the US dollar clearly wins all over the world, because even if you are a Polish exporter, you're selling something to a Hungarian importer, you'll probably be very happy using the dollar, even as you sit in the middle of Europe. All right, for example. Anyway, gold has that. So that's a huge plus for it. Number one is that really anywhere in the world, people are generally happy to take it because it's performed that role for thousands of years. Two, and I suppose versus the Bitcoin point, it is much more stable in terms of its pricing. It is very volatile. Don't get me wrong, but compared to an asset like Bitcoin, it is much more stable, and therefore it's easier to use as a store of value, right? I mean, if you use Bitcoin to transact for something in a year's time, God knows what you will be at. Whereas gold, while obviously very volatile, will probably be less volatile than Bitcoin. And three, and this is probably the most important crux for today, okay, is that while you rightly mentioned it doesn't have a yield, and while holding it while you're getting a yield elsewhere is painful, typically when there is stress in markets, when there is genuine fear, when there's genuine tail risk events that materialize, people tend to flock to gold, right? And all of those other factors about its real value, yield, etc., tend to fall away. Okay, people still hold it when there is a crisis, and that is ultimately one of its greatest characteristics. It is a diversifier, typically when things get really bad.
And I guess that's probably the explanation why we're seeing sort of central banks buying records amounts of gold, because I haven't seen the figures for 2023, but I think 2022 was one of the biggest years for central banks buying gold, wasn't it? I think since 1950 or something, that was one of the figures I saw. And I guess 2023 is probably looking good as well, off the back of what we're seeing happening in the Middle East and Russia or Ukraine as well.
Well, yeah, look, so central bank, all central banks will hold some gold, and obviously even the US famously stores all its gold at Fort Knox, and and what have you. So all central banks will hold it, and it diversifies a little bit away from US dollars, particularly if you are a central bank that happens to belong to a country where the relations with the US aren't so great. So think a Russia, for example. There's clearly value in holding an asset with a physical dimension in a vault that is easily transferable elsewhere, etc. So all of that. So yes, central bank buying, will always probably increase in a time where there's increased global fractiousness.
Yeah. So essentially, then, to sort of sum up, then we're saying that gold is looking attractive, and this is not a recommendation, obviously. A lot of people are going into gold at the moment because we're going through a period of very heightened geopolitical tensions. And it's working well at the moment. It's negatively correlated to equities. I think that's fair to say, isn't it? So it's a good diversifier in portfolios, and I guess it's understandable that it's seen as a safe haven in what's going to be perhaps quite a difficult year from a geopolitical point of view. As you say, we've got lots of elections going on this year. We've got the big US elections in November, and so it's understandable that people are a little bit nervous and are going into gold for that security. Even though you don't get that yield from it, it still has that attraction from a safe haven perspective.
Look, ultimately, the most important sort of word in what you just said is correlation, right? And really, at the end of the day, the whole reason why we have multi-asset portfolios is specifically to get diversification and things that are either inversely correlated to each other or not correlated at all. Now, what is particularly important right now is that traditional safe havens like bonds are performing very similarly to equities, right? Everything is moving on the same rate story. So if rates go down, equities and bonds both rally. If rates go up, equity and bonds both fall. That's actually quite dangerous, right? In a multi-asset portfolio where you're holding bonds in order to be a diversifier, the fact that everything is moving together actually makes you more risky, right? Now, strangely, I would love to say to you that gold is the perfect answer to this conundrum, but it's not, because gold is also moving relatively similarly to bonds and equities, but much less so, right? Than bonds and equities. So the correlation with bonds and equities right now is called 0.8, but the correlation between gold and equities is 0.5. So at least it gives you a little bit something extra, and it sort of tends to dance a little bit more to its own tune. But also, as I said, all of this correlation stuff, right, will probably tend to fall away in the event there is a serious crisis. Now, we've seen that throughout history, right? So, gold hit its all-time sort of high in 1979 in December when the Soviets crossed their tanks into Afghanistan, right? So that was one huge factor.
Yeah.
Gold, once again, hit a recent high when the Russians invaded the Ukraine in 2022, etc. Even when the pandemic hit, for example, not obviously a geopolitical stress, but when that happened, gold in the immediate sort of aftermath aside, it went up quite handsomely as well, because it was a period of such uncommon stress. Point is, all of the correlations and its real value versus and yields, etc., all of that tends to fall away when things get really bad, and that's ultimately why you want to consider it in a portfolio, particularly in a world where the normal safe havens bonds are not performing as reliably as a hedge as you'd like.
Okay, all right. Thank you very much, Fahad. So moving on from one asset class that sort of is proving to be attractive at the moment, you want to talk about China, which is it's in the news a lot at the moment. There's quite a lot of, we saw Evergrande, I think, that's actually going to be wound up now. But there's a lot of, perhaps, I don't know, there's a lot of bearish sentiment about China. Is that sort of igniting your contrarian instincts, Fahad?
China is such a big topic. We could honestly spend a podcast or two on it alone, but very sort of briefly, I would say that, look, it's an impossibility to ignore. China is an enormous factor in today's world, right? It's well over 1 billion people. It's got an enormous economy, and that economy is still chugging along at 5% a year. A level that we would eat our arm off for in the UK or the US or any other developed country, really. So it's still, and by the way, it's still on pace to eclipse the US economy at some point in the near future. So it is a huge factor. Now, the problem is that in spite of that huge growth, right, and that 5% GDP growth, etc., very little of it tends to translate into corporate earnings or reliable sort of stock market performance. That's the big issue, right?
Yeah.
If you take a country like the US, for example, even an emerging market like India, for example, right, there is quite a strong correlation between GDP growth and how companies perform, as you'd imagine. It's very intuitive,
Yeah.
right? As the economy grows, companies should be making more earnings, and those earnings are good for the shareholders that hold those companies, and those will go up over time. That's the sort of loose correlation, right? In China, that doesn't seem to work. It's very, very controlled at the top. As we've seen over the last 2 years, when certain sectors, call it ed tech or fintech, etc., fall afoul of the authorities, there is draconian crackdowns that come down, and you take a company like Alibaba, which was, rivaling, in terms of valuation, was rivaling, maybe even Apple and Microsoft for a brief period, and it's been whittled down to size, a fraction of what it's worth, because it was the subject of quite brutal sort of assault by the Chinese authorities. That kind of thing happens in China, and that is a factor that you must keep into account when you're investing in it.
So is that the point then, that Chinese companies are not showing that sort of positive correlation between growth in GDP and growth in their own corporate earnings? Because if they get too big and too successful, there's the risk that they'll be brought under some sort of control. Is that what we're saying?
Well, partly, yes. I mean, I would sort of, put it probably even simpler than that, that there is just a huge risk and scope of government crackdowns, of government interference, which interferes with the normal mechanism of profits leading to shareholder returns.
Yeah, Alan, you wanted to say something.
Yeah, I think, Fahad, I think you're spot on. I think, look, we know it's a cheap market, 10 times earnings. It could be a trading buy, but to have large weightings. And by the way, before we go to large weightings, property crashes, I'm less concerned about that. You may remember, Fahad, in Hong Kong's house prices fell 40%, 97, 98 in the financial crisis. And Hong Kong bounced back. We've seen property busts all over the world. What Fahad's spot on, for me, it's all about corporate governance, is that we are minority shareholders as a fiduciary. And if we can't be confident that our interests are being looked after, then the asset has to be very cheap. 10 times earnings is cheap, but when something's 10 times earnings, very easy to trade at 8 times earnings. And I think excellent point. India has translated growth into earnings per share so much better than China. It's very, very disappointing. So for large weightings, for me, these days, I only advise Fahad and team decide, but for large weightings, I would want to see a complete sea change towards minority shareholders in China. For me,
I guess the other challenge for Chinese companies is externally, you're seeing a lot of talk of US companies or European companies, so-called de-risking, where they're trying to remove the risk of relying too much on China for whether it's raw materials or whether it's technology. And that obviously is going to have an impact on Chinese corporations, isn't it?
Yeah, I mean, I'll jump in. Give Fahad a rest. I think you're right. There's. I mean, look, there's some fantastic Chinese companies, and if you can find some nuggets, maybe an active fund out there that is really, really interesting, of course. But yes, I mean, going back to what Fahad said on gold, geopolitics isn't particularly helpful here. That can change. That can thaw. It doesn't seem likely right now, but it can change. But at the end of the day, go back to basics. Minority shareholders, we need management and the business environment to be at least neutral. And sadly, it doesn't seem to be the case in China in many industries.
So what are the?
I just wanted to. Sorry, I just wanted to jump in there, Sarah, and say that, that sort of Alan's point, though, about valuation is an important one, right? So we know that there's lots of terrible, scary things in the Chinese market, right? We know that. But as one of my favorite investors, Howard Marks, said, there's no asset, no matter how high quality, that you can't overpay for, and no asset, no matter how sort of scary or poor quality that you can't buy at a bargain. And Chinese valuations really are looking, as Alan alluded, screamingly cheap. Add on to that they are massively underowned right now because everybody is so terrified of them. When you add those two factors, cheap and unloved, right, and then you add into the fact that maybe, given that government involvement and interference is such a huge factor, and that pendulum might be swinging in a more positive way now after a few years of being very negative. I mean, this might be sort of, the great sort of opportunity of a generation. I've been saying that for about a year, and I've been quite wrong. So we'll never catch it perfectly.
Well,
but I just want to leave the point out there that that yes, all the negatives are there, but there's a price for everything, and this might be the right price.
Okay. And I mean, certainly, I think Goldman Sachs are relatively bullish China at the moment, aren't they? Whereas I think Morgan Stanley are a little bit more bearish. So what we're saying is that Chinese equities, they're cheap and they're unloved, probably for a reason. But that's not to say that there might not be some opportunities there for the smart investor. But you've got to know what you're getting into. For the brave one as well. Okay. Any final thoughts from you, Alan, on China before we move on to your topic?
No, I think you're right. I think I like the point of cheap and unloved. So a trading rally, and by the way, that could be violent. That could be 50% in China. A trading rally could be 50%. But if you did get the cheap, you've got cheap unloved. If you did get increasingly strong statements in favor of the stock market. To be fair, the Chinese government have already set out Bank of Japan style buying of the Chinese market. And if there really was more of an embrace of the private shareholder, China would be a screaming buy, absolutely screaming buy. But that's, if you like, fundamentally what I'd be looking for personally. But look, it's so unloved. Could we have a massive trading rally? Of course we could, and that could be big.
I think Goldman Sachs are predicting something like 20% that the index will end up 20% up by the end of the year. That was, I read somewhere. Not quite as big as York, but a decent size. Okay. Well, thank you very much, Fahad. Now we come to you, Alan, for your final point. Fahad, please feel free to jump in on this one. Back to the subject of property, which we talked about last week, and you talked about this sort of formula for the valuation of a property, and there were a couple of people who took issue with that, and a couple of people agreed with you. But I know you want to talk a little bit about commercial property, because last week you were talking more about residential property, weren't you? So should we address first of all the challenge to your very rational, mathematical, logical approach to valuing property? Because because we had one of our listeners, Tristram, did say, he messaged me and said that, I mean, he used to be an estate agent in the Cotswolds and was also a property developer. And his argument was that there was an art to valuing property, and it was a real skill, and it was not based on yield. Thoughts on that?
So I get where he's coming from, and he's partly right, but I can't believe he doesn't love my formula, Tristan. So a reminder of the formula. So a yield on a property is the income divided by the value. So we talked about something that's renting for 40,000 a year and has a value of £1 million today, and the yield is 4%. So keep dropping some names here, but thank you for all of you getting in touch. But agricultural investor James got in touch. He said you can confuse a lot of investors by saying the value is the 4%, because in property land, especially commercial property, which I'll come on to, people don't talk about the million number. They say it's valued at 4%. That is the number. Now, I get it. Look, on an amazing cottage in Cotswolds, which is beautiful, people will want to pay £1 million for it, even if it rents for virtually nothing. Nothing rents for nothing. And it's a lifestyle thing. There's plenty of lifestyle. But if you put a cold, hard yield on that, that yield may be as low as 0.5 or 1%. By the way, the likes of Belgravia can be like that in London. Why? But that is in effect saying, still mathematically, you can sell it, find a rental property. Yeah, it's not emotionally the same, and basically you're exiting at a valuation of 0.5%. To use Tristan's example, but it works it is how commercial property works, and I stand by it. And the way I would think about it, Belgravia, yes, very expensive, very desirable, Eaton Square, etc., 1 to 2% yields. Whereas, I don't know, to pick a London area where I first moved to many years ago, now desirable, Peckham might be on a 4.5%, 5% yield. And you can put everything in terms of yield. So I would like, though, to Angus, the commercial property investor who was listening in, got in and he said, team, you're exactly right. That's exactly how property should be invested. But he went on to say, however, the formula, in his belief, undervalues commercial property. And I said to him, yeah, well, you would say that, wouldn't you? Someone famous said that, didn't they, Sarah? You know your history. What was that? That was
no,
was
I can't remember who
scandal. Christine Keeler.
That was it. Yes, Christine Keeler.
Yeah,
yes, the Perfuma scandal.
Yeah, thank you for that. So he would say that, wouldn't he? So look, I'll give you a couple of examples, and then I'll be really interested in Fahad what he thinks. Firstly, commercial property can really work as an investment, but it's really tough to put in portfolios because obviously it's a liquid. But we talked about the Blackstone REIT before. Last year it had a dull year, lots of redemptions. It's still a 60 billion odd fund, but it has compounded at 11% since inception over the last 7 years. Okay. So it can work, and absolutely. But to give it to use some commercial property language, I'm going to give you the Belgravia of commercial property.
Okay.
Wembley Logistics, where Amazon are, traded last year at 3.5%.
Okay.
Do you know who bought it? Quite interesting who bought it.
Oh, I don't know.
The Mormon Church.
I was going to say, was it a sovereign wealth fund?
No, the Mormon Church bought it. The Mormon Church bought it as part of their. That shows how wealthy they are, But 3.5%. So why does that trade at 3.5% in Wembley? Well, one, the tenant is amazing, Amazon, right? Yeah. And it's going to grow in the long run, and it's rock solid. In contrast, that's 3.5%. So that's our Belgravia example. In contrast, our Peckham example, and this is especially for Andrew Christie, our colleague, our man of the north from Preston. I found a transaction in Matalan. Have you ever been to Matalan? I don't know, Fahad, have you been to Matalan? It's a kind of a geeky shop, isn't it?
I've never been to Matalan.
I don't think I've had
I think you get tech kind of stuff. Okay, it's 9 years only. That traded at 10.7%. And this is the important thing. So they say the value is at 10.7%. They get the rent and they impute, therefore, the monetary value. So the value, so basically the yield drives everything, is the way of thinking about it. Now, to be fair, so Angus says this undervalues commercial property, this formula, because the terminal value, because of inflation, will be higher at the end. Well, I do question.
So based on your calculation, the property in Preston is worth more than the property near Wembley.
No, sorry, Sarah, to say no, because again, let's go to the formula. The value, the amount of cash you have to spend is the income divided by the yield.
Yeah.
Remember that formula, income divided by yield? Yeah. So only two ways the property, residential or commercial, can go up, okay? Very low yields.
Yeah.
And yields going lower, or higher rents. Now, you get higher rents in the long run, in resi and commercial. It's actually contractual in commercial, so you get higher rents. However, think of it this way: you whatever the income is, Amazon say paying £1 million, I don't know what they're paying in rent. It's divided by a low 0.035, 3.5% yield to make the value very, very high. In contrast, the Matalan in Preston at 10.7%. In a way, it's saying this is not the highest quality investment, and there's some doubts about the terminal value. No matter what Angus saying, the terminal value is always higher, because he was going on to say, it can be used for residential. I says, well, maybe. There's plenty of examples of office buildings that don't have the terminal value that they used to. But it is the way the commercial property market works. And you can see, look, owning Amazon risk at 3.5%, which will be a growing income stream for years and years, you can see where the Mormon Church did it. Yeah. Cash is higher. Similarly, owning Matalan, I don't know a lot about Matalan, except it's geeky tech stuff that people buy in there. At 10.7% 9 years, the experts think Matalan's a good risk, and Preston will be the place to go to in 10 years' time when this lease expires. But I don't know, Fahad, what's your experience being in investing in commercial property? Do you get as frustrated as I do with the liquidity and the bad kind of fund structures that you come across?
My experience is not great. I recall being gated from a fund that we held at my previous shop many years ago, and and that basically it sort of has informed me really about that, right? I mean, it is an illiquid asset class. You are at the end of the day buying commercial structures, whether it's warehouses, offices, what have you, shops, etc. And it's not so easy to get out of, right? But if you have the right property and and you are after a steady income, I mean, it's great. But what is the right property? What is the right yield, etc. How much how much liquidity can you sort of can you stomach? All of those questions about now. But I will just say one final thing is that so those questions need to be answered by experts, and it's not to be done by the casual sort of observer. But like China, right, there is a price for everything, right? And clearly we are at a juncture within the commercial property market, not so much residential but commercial, where because of these whenever everybody's going to be working from home now, and occupancy rates are low, etc., that we may well be at that similar China moment, right, where things are much cheaper and sentiment is usually against. And really, if you think that the Philip point is that American banks are forcing people to come in 5 days a week and they tend to set trends, and soon you might see that elsewhere, and all of a sudden these commercial properties, which are really cheap because everybody's worried about their future, suddenly come back in vogue, and this might be once again the big generational opportunity. As I said, not to be done by the casual observer. And you've got to be really aware about the risks and the potential reward on offer.
Yeah. And thoughts, Alan, then on obviously the big challenge with these commercial property funds, with REITs and things like that, is the liquidity, isn't it? How do you address that?
Yeah, so quite right, and the warning and rant coming. So the 3-day liquidity funds that we have in the UK, ridiculous. And the FCA have been sitting on their hands. This is going to get me in trouble with the FCA. We've been waiting for their report on property funds for, I think, is it 5 years? It's definitely 3 years. And that needs to go. The Blackstone REIT tried to make it work with limited liquidity. Like you could withdraw, say, 2% a month. But even that had issues. I mean, there are closed-end vehicles, so investment trusts, what we call them in the UK, that works. But it's tricky. Everything that Fahad said is right. But to be fair, look at the performance of Blackstone REIT and others over 7 years, 11% compound, even in a pretty tough commercial property market by a decent manager. There are returns. After all, we talked about gold as one of the world's oldest investments. Property is also one of the world's oldest investments. It's basic. However, to Tristan, and thanks to my friends who came on, who was it, Angus, the commercial property, and James, our agriculture man, they stand firmly behind me, in contrast to Tristan. Yield is the right way to go. Resi or commercial, start thinking about property in terms of yield. Yield is the valuation, and start thinking there's only 2 ways my property can increase. Either the rent goes up or my yield comes down, whether you're in Preston or Belgravia or Wembley.
Okay, all right.
Or the Cotswolds for Tristan.
Or the Cotswolds. So if you missed that was last week's episode of Need to Know, when Alan got me to do some maths. Which was my favourite thing to do. But it's an interesting formula. I would still take issue because I think residential property, there's still an element of emotion, more emotion than there is with commercial property. I think we're going to have to agree to disagree on that one. Anyway, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, Alan and Fahad, for coming on Need to Know this week. And thank you everyone for listening and for all your comments. We're getting some really great feedback and some really great suggestions and challenges to some of the things that Alan says. It's not, I get things wrong, but Alan gets things wrong as well. So that's always good. That's all for this week. We'll be back next week with more Need to Know. Now, a comment I had in, this is not a subliminal message. Until next week, bye for now.